So we're absolutely honored to have Wally Weitz here with us today. Wally Weitz is the co-chief investment manager of Weitz Investments. Since 1983, he has served as the portfolio manager of Partners 3 Opportunity Fund and Partners Value Fund. Since 2003, he has also been the portfolio manager of the Hickory Fund. Mr. Weitz began working in the investment industry in 1970. He began by working as a securities analyst at G.A. Saxon Company, and then transitioned to being an analyst and portfolio manager at Childs Hyder and Company. Mr. Weitz received his bachelor's degree in economics from Carleton College. Thank you for joining us today, Mr. Weitz.
Good to be here.
Excellent. So let's dive into the questions. So our first question today is how to analyze a company's management. What questions do you typically find yourself asking the management of a company?
Well, it's hard to get at it directly, I think. We do like to get to know the managers of our companies. We read about them and what they've, their deeds or misdeeds in the past. And a lot of times, especially in the modern era now of FD, they're wary, and it's harder to get them to open up. But we find that once they realize we're really not, we couldn't care less about the next quarter, that what we really want to know is what makes their business go and why is it going to be good 10 years from now? What are their long-term plans? But it's not really any specific thing that we're going to learn, but we know that every 5 or 10 years, there's going to be a crisis of some sort, whether it's just their company or the whole economy. And they're not going to ask our advice at that moment. So we need to have confidence that when that time comes, they'll make the right choice. And we want them to not be worried about what Wall Street's thinking, not thinking short term. We want them to be bold if appropriate, but make sure the downside's covered. And so we get at that any number of ways. It is harder to get FaceTime with management these days. It was a lot easier 15, 20, 25 years ago, but you can get a sense of people.
Yeah, that makes a lot of sense. Thank you for sharing that. And our next question is, it says there have been some very interesting consolidation plays in the media space lately, including the Warner Media Discovery merger and Amazon's purchase of MGM Studios. Can you discuss your thoughts on those mergers? Do you believe that there will be further significant consolidation in the space? And how do you see that sort of affecting some of your investments in the media space?
Okay, well, we've owned Time Warner and Discovery and several of the ones involved in the past, but haven't for the last few years. And I think we've decided in more recent years that the distribution and the broadband product are a lot more important. So we've tended to own the cable companies. But as far as they talk about tonnage in product that Netflix and Discovery and the others can offer, and that's what those mergers are about that you're talking about. Of course, with AT&T, they've made what seemed to us a series of missteps pretty consistently over the last 20 or 30 years, one of which probably was Time Warner. So they're just trying to find their way out in a way that can service their debt, I think. But it is all about scale. Netflix is the clear leader and winner that everybody thinks is the best company, and I would agree with that. And yet it'll only be maybe this year or next that they'll actually have free cash flow, because they've been spending billions and billions and billions on new productions. And so it's a giant game of trying to outrace each other. It seemed everybody talked about unbundling with cable bundle, going back 5, 10, 15 years. And we always thought, be careful what you ask for, because now there's a lot of unbundling and people are being asked to pay $5 or $10 a month for this and 10 or 15 for that. And I don't think that people are going to reconstruct their bundle by having 12 streaming services. So consolidation, feels necessary. It feels necessary to the ones that are playing offense, and it feels necessary for the ones that need to get bailed out of their current situation, because they're being left behind. So I expect there'll be plenty more. As I say, we haven't owned a lot of programming companies lately, but we probably will again. Things come around.
Yeah, thank you for sharing that framework. It's very helpful. And can you discuss why you decided to locate Weitz Investment Management in Omaha rather than more traditional financial hubs like New York City, for example?
Yeah, well, I grew up in New Orleans and went to school in Minnesota, and met a girl from Minnesota, or from Omaha in Minnesota. We moved to New York and lived there 3 years, and we realized that New York was, it was fine if you had nothing, and it was fine if you were a gazillionaire, and we had nothing. So it was interesting, and there was a lot to do, but we really didn't appreciate the pace and the crowds and the noise, and started thinking about having kids, and I didn't really want to commute for an hour and a half. So we looked in Omaha, we looked in New Orleans, we looked, how I don't know how old you are, but at 24, the things that you think are the most important turn out maybe not to have been. But so, if I'd known about skiing then, I probably would have looked at Denver. And then, if I knew about surfing, I'd have probably looked, in Southern California. But my wife was from Omaha. I'd come to like it as a place to be day to day. And the job offer that fit was there. And so I went to work for a brokerage firm for 10 years. And it's a great, I always say it's great for what it doesn't have. And we were escaping some of that New York things. But it works, it worked fine in 1970s and 80s. And certainly today, it doesn't matter where anybody is. If we did more international investing, the airports, it adds an extra 3 hours to whichever direction you're going across to Asia or Europe, but it's not a big deal. So it's turned out to be a very comfortable place. It's it can be a little hard for recruiting because people don't know what they're missing, some of them. But it's great for day-to-day life, and turns out lifestyle is an important thing.
Yeah, and you have the Berkshire Hathaway annual meeting nearby. That's always helpful as well.
Oh yeah, well actually that I had heard of Buffett before I came to Omaha, but the firm I went to work for was run by a guy who was a good friend of his, who made sure I went to the annual meeting in 1973, where there were 3 of us from the outside in the lunchroom of National Indemnity. It was pretty interesting. But Warren, Charlie, or my boss Charlie, would take my questions up to Warren on Saturday mornings, because he always would stop and talk to Warren on the way home, and it was a great way to get questions answered about how float works and various things. But then, Warren's turned out to be, something of a friend, and he's helped me at 2 or 3 points of, career advice. And I'm on the board of trustees of his philanthropic foundation. So that's a whole nother interesting thing. But that's as far as pure business importance, learning about Buffett was the very most important influence on my career.
Yeah, that's incredible. And you also followed sort of a similar trajectory, starting out focusing more on cigar butts and then moving more to those long-term compounders and those really high-quality businesses at a reasonable price. What sort of reading materials do you recommend for student investors who hope to follow that transition as well?
Boy. I'm trying. Yeah, well, I mean, people should start with Warren's Berkshire letters, and they're all available all the way back. But and really, actually, the book that Carol Loomis wrote about Warren, it's I think it might be Tap Dancing to Work or something like that, is really a collection of articles that she wrote or others wrote over the years, with her comments about getting to know Warren, and it's really a good one. There's a new one that Hagstrom's written about Warren that I haven't read yet. Well, I've read half of it, but I think it might be for a serious student. It's a little meatier than some. But the idea, it took me a long time to get around to some of the higher quality businesses, because I don't know if this was characteristic of old time value people, but the idea of something growing fast was it was clearly worth more, but it took a long time before I actually was willing to believe that the growth rate could continue. And a part of that is not understanding technology very well and thinking that the product cycles were short and so on. But gradually, with a few youngsters working with me and learning a little bit about some of these things, I got more comfortable. And now, of course, we've been in a long-term bull market for these fast-growing things and the internet stocks and the platform stocks and that sort of thing. And so you get constantly reinforced because the thing you bought, it works. And it may be because you were smart and made a good decision, or it may just be because of the index money flows and all sorts of other factors. So I try to remind my colleagues not to ignore the more prosaic companies if they're actually really pretty cheap. And I didn't do it, but when oil went below zero and the energy sector of the S&P got down to like 1 or 1.5% of the total market cap and that sort of thing, you probably could have just blindly bought some sort of a play. So I've kind of stopped doing that. I might have done that 25 years ago. But understanding what a business really is about and what it's likely to look like in 5 or 10 years can work for the most exotic companies, and it can work for some very prosaic ones. And I think Warren's discipline about not playing when he doesn't feel highly confident. It's not that he doesn't make many mistakes, but he does make some, but he goes in expecting to win. And when there's interesting plays that ought to win or probably will win, I used to do a lot more of those back in the day, and I'm trying to learn from Warren to be a little more disciplined about it. But my colleagues do like to say that with partner, we have several different mutual funds, and they all have very similar approaches. But Partners 3 is where, as one of my colleagues says, I get to color outside the lines, and so I take license once in a while, and sometimes it works.
Yeah, absolutely. And another question discussing what you just discussed regarding oil and natural gas. How are you assessing those industries of oil and natural gas? Because on the one hand, because sort of financial institutions have been reluctant to invest in those industries, there's probably going to be limited supply going forward. But on the other hand, on the very long term, demand will probably decrease for those commodities, and you might have increased future regulation in those areas. So how do you sort of assess that balance?
Yeah, well, I think it's a lousy industry, basically. I mean, you're at the, it's, I mean, aside from being dirty and disruptive to the environment and all those other things, which are true, it's a commodity business where if you look at the price of oil, that's, I mean, forget the fluke with the futures where it got below zero, but if it's traded between 25 and 150, round trip, several round trips, you're guessing when you're, and I'm not against trading and speculating and that sort of thing. It's not immoral, but it's not particularly investable for us, and we really haven't owned any energy companies probably for 10 years or so. But still, if somebody has a barrel of oil available to sell, and the going rate is at least 25, and you can buy it for $5, you'll probably win. But some of my most fun cigar butt stories from 30 years ago, turned out to be 5-baggers or 10-baggers. But they took a lot of time and distraction, and it was really, as it turns out, it was more about entertaining myself than making money.
Yeah, that makes a lot of sense. And what, I may be mistaken here, but what changed your viewpoint on oil and natural gas? Because I believe that earlier in the decade, you had several companies that were sort of in that area. So what sort of changed your viewpoint on that industry?
Well, I think that I can remember. Well, I'm not sure I'm going to get the timing right, because my memory is sort of faded on that, and maybe that's on purpose. But I think we've been willing to say we think the commodity price range, and this isn't just for oil and gas, but if the commodity price range is likely to be from 10 to 100, and the stocks are out of favor because the commodity is trading at 11, the odds are good if it's a product that's actually going to be needed for a long time, and oil is just going to be needed for years. The odds are pretty good that you can make a trade there. And I think we did that with, we've done that with various oil companies going back a ways, and with when some of the shale plays more recently. But it really was more about guesswork. And it turned out we were at that, over that last 10 or 15 years, we were getting to be more comfortable with things like Google. And, buying Google, we bought Google, at 17 times earnings, which sounded high to me as a, 10 or 12 multiple kind of guy. But it turns out it's such a better business and growing so fast. Our analysts do DCF models on all our companies. And, I take those with a little bit of a grain of salt, because as there was a money manager at Third Avenue that he said the DCF is like the Hubble telescope, and if you move it a quarter of an inch, you're in a whole different galaxy. And I think that's about right. And I think I'm detecting among my colleagues maybe a little bit of terminal multiple creep. We keep our discount rate the same, but the terminal multiple, maybe it really ought to be 19 instead of 17. Oh wow, that makes a big difference. And again, we get reinforced with it these days, but we don't want to confuse that with what a serious, well-informed business person would pay for the whole company. if he was going to own it forever, and that's the acid test. So energy
Yeah,
just doesn't really fit. Although like I say, I never say never, but
yeah, absolutely. Thank you for sharing that framework. It's very helpful. And yeah, people are wondering for the FANG stocks that you do own, how both for the FANG stocks you own, how are you sort of valuing them? Like, how are you looking? Because at first glance, they look like they're at high sort of P multiples. So how are you valuing those? And then also they're wondering if you could please rank the FANG stocks and Microsoft by what you believe is the strength of their moats.
strength of their mother. Well, we owned Microsoft from 20 to 40 and thought we were really pretty smart. But hopefully we've gotten a little smarter about it. I'm not sure if I could rank them. Google and Facebook are about advertising, and that's really, that really is sort of really we're at home in media, and those are just turned out to be much better ways of doing the old thing. And they're both terrific businesses. I have some qualms, especially about Facebook, about some of the byproducts of what happens there. And I think of Facebook as a really efficient way of helping people be themselves. And for some people, that's not a good idea. So I have some qualms about that. And of course, I think one reason they're still reasonably priced today, I think, is because there's fear that regulation will come along. But I think our take on that is that if a regulation imposes very expensive extra processes to take care to prevent bad things happening, that they can afford that better than any of their competitors. So, but we do DCFs on those, and giving them a wide, a wide range of possibilities. But Google and Facebook seem still more or less reasonably priced. Amazon. I met Jeff back in 1970, I believe it was 1970, and at an Allen conference. And Bill Miller and a couple of others and I were standing around after dinner talking to Jeff, and the stock was $7. And Bill said, "Jeff, you've really hit rock bottom now, because you're talking to 4 value guys." And Jeff said, "Oh, I know, but come on out, and we'll show you around out there." And he and his top 3 other people spent half a day with me and a couple of people from the office. And all I could see at that point, this is I'm sorry, it wasn't the 70s, it's 2000. And all I could see was that they were spending more on building new things than what they were taking in. And I just, it's like, will that ever end? And I didn't buy it. But we finally got around to it at around 1300, just based on, hold your breath and look and make guesses on a DCF, and it seemed plausible. And now I think it shows up as being 120% or 125% of value, and we're supposed to have sold it already, but I just didn't do it. It's such an amazing thing. I mean, for them to decide to start their own FedEx and UPS operation, that's unbelievable, and AWS, and Now, people may worry about them trying too many things, and I noticed the stock went down the morning that Jeff landed safely. So maybe somebody was hoping something else would happen. I don't know. But Microsoft's, it's just so entrenched. I don't know. I have no idea if the price is right or not on that. But I do think that we've gone so long being reinforced for owning those things, and every dollar that comes out of an active manager and into an index fund goes 25 cents of a dollar goes into those 5 or 6 stocks. It's probably it's probably gone too far, and it'll need to correct. But then when you think about the very mediocre companies that you think ought to be selling at 12 times earnings and they're selling at 20 times, then you say, well, I'm not going to go slumming just because it's a lower multiple. I think maybe I put it somewhere in that outline. The idea that we have artificially low rates for the last 12 or 13 years, and money being pumped into the financial assets by the Fed has created a completely unreal, unnatural situation, and we've all been beneficiaries of it because it pumps up the values of our portfolios. But we should not. There's an old joke about don't confuse luck. What is it? Don't confuse a bull market with brains. I sort of suspect that all the valuation work that the perma bears do are actually correct. It's just taken 13 years. And I think as a firm, I think we had a 3 or 4 year lull in performance from, sort of 15 or 16 through 18 or so, because we were just so skeptical. And I was, insisting on holding 30 or 40% cash, and it just, we kind of got left behind. So, I expect there'll be fireworks and comeuppance and change, but all I know how to do is, hold on to a group of 20 stocks or so that I'm pretty sure I'm going to be glad to have 5 years from now. And I don't know whether, if there's a correction, I don't know whether it's down 50 and it's over, or if it goes sideways for 10 years. I mean, that's what happened from 66 to 82, is 16 years of going nowhere. And within that environment, there'll be things to do. So I don't despair, but I'm getting kind of tired of, I prefer volatility and fear and loathing and crashing and the chance to buy wonderful things at panic distressed prices, and it's just, boy, it just doesn't happen much, but it will.
Yeah, absolutely. So let me ask you a question about that. With the markets being fairly overvalued in the US and also in some other countries as well, but why have you decided to stay focused mostly on US domiciled companies rather than trying to expand more internationally with investment?
I think it's it's just a matter of our circle of competence. We do have, we have gradually built up a investment team of 10 or so that some of whom do a fair amount of traveling. One spends a lot of time actually in China, but every time he comes back, he says, I'm really glad I went, because our domestic companies that are doing business over there, it's important to them, and it's good to understand how that works. But the idea of owning most of the Chinese companies that he sees, it's not that they won't be great businesses. It's just that you can't count on the rule of law. And I mean, that's been his pitch for 10 years. And sure enough, this last few months, we're getting a big taste of that. So, and you know, there's European companies that are, you know, sort of, this, you know, versions of the same thing. And we own, well, we certainly own a lot of companies, a lot of what are really domestic companies, but they're domiciled other places for tax purposes. That doesn't really count, I think. But we've not had the horsepower to go trying to understand emerging markets and that sort of thing. So we've so far sort of stuck to our roots and usually find plenty of things to do. But I think I'm guessing over the next 10 years, it's sort of inevitable that you'll see more global companies, foreign-based companies showing up in our portfolios, and who knows, we might even have a international fund someday. It all depends on our people and what they're interested in and what they're able to do competently, because there's a lot of awfully smart, experienced people that have been doing it for decades, and to think we can just parachute in and compete is, I think, a dream.
Yeah, that makes a lot of sense. Thank you for explaining that. And semiconductors have obviously been a very global issue lately, their shortage. How do you think about investing in companies in the semiconductor industry like Analog Devices?
Yeah, you know, they've always been a mystery to me, or for a long time were a mystery to me, and I love to read about them. Walter Isaacson has a great book that's sort of the unfolding history of the whole semiconductor industry, called The Innovators, I think, that I'd highly recommend if you're interested in that sort of thing. But we have one guy in particular on our investment team who has followed them for 10 or 15 years. And you know, I think he's, you know, taught me that they are just, you know, it's just another business. Now the analog as opposed to the digital is, you know, we're much more interested in the analog side because the product cycle there much longer. And the first one I actually brought to the group and we bought was Texas Instruments, going back probably 6 or 8 years now. But again, I was at an Allen event where it was there was just 6 or 8 portfolio managers, and they would bring in a CEO every day. They'd bring him in for dinner. We try to keep him up as late as we could, give them some whiskey if they'd take it. Then in the morning, have breakfast with them, send them on their way, and bring in the next one. And it was a beautiful format. And one of the ones was Rich Templeton from Texas Instruments, and he was there for dinner. And we had a drop-in guest who was Bill Gates, who had just been in the neighborhood. This is out in Cody, Wyoming. He was in the neighborhood looking at a ranch he was buying and was friends with some of the Allen people. So he stopped in. So we were having dinner, and he started kind of chirping at Templeton about what a crummy business the analog semiconductors were. And I think he was particularly thinking about the products that went into cell phones, which was becoming a commodity at that time. And Templeton just sat there. I don't, you probably don't know what he looks like, but he was sort of, you know, sort of 50-ish, flat top haircut. And I can't remember if he had a pocket protector, but he probably could have. And but he just sat there and calmly responded to Gates, and then gradually took over the conversation, explaining to him why it was a great business, and it had nothing to do with the things that Gates was talking. Anyway, so it went on, and I mean, it was so impressive that, and I think the stock, I think it was around 12 times earnings or something. So I didn't really know exactly what a semiconductor was, but we bought it. Now, Barton, our analyst, blessed it with a DCF and all the rest, but it was the management that did it for me there, and they are just, you know, in the next recession, or in the last recession, they had bought a 300 millimeter fab from a Japanese company at like 10 cents on the dollar, and they'd had no immediate use for it. So they kind of mothballed it for 2 or 3 years. But when they finally needed it, they cranked it up, and they had a capacity that nobody else had. They're good. So the analyst knows about them more than I do. Analog. Is that which one did you ask for?
Yeah, it's analog devices. Yes.
Yeah, analog devices. Yeah, and well, I was at GA Saxton in 71 or 72 when that came public, and we were part of the underwriting, so I knew the name, and it didn't do very well, as I recall, because then the people around the shop called it Anadog devices. But that's all I knew about it. And then Barton brought it up and said, you know, if you like TI, then I think analog will work too. And so we added that 2 or 3 years ago. But I can't tell you anything scientific or very useful about it, except that I think they're really good business people, along with being scientists.
Yeah, absolutely. And I would like to discuss another, a past investment of yours, Valeant Pharmaceuticals. Can you describe sort of what was your mistake when making your thesis on that investment, and what have you learned from that experience?
Yeah, it's funny. You know, when you asked at the beginning about management, turns out everything I'm telling you is about management, I think. But one of our analysts who was very tuned into healthcare got interested in this in the 30s, and they were growing by acquisitions, and it's like we can produce and manage and sell better than the little guy we bought it from, and so it's sort of a private equity story. It turns out they were just really gouging on prices on a lot of it. Used a lot of debt. We rode it along. We asked ourselves those questions, but the stock kept going up, and so I don't know, a year or so in, the stock was up. I can't remember now. I think it may have peaked out like 250 or something like that. And we had been, selling on the way up, and we got a chance to go to dinner with Mike Pearson, who ran it. And the story was he had come from McKinsey and knew everybody in the business. That's why he could source these acquisitions best, and blah blah blah. So we're sitting there having dinner. We flew out to New Jersey, in this little town in New Jersey, and had dinner with him. And at one point, we were asking about how do you manage these. Some of these acquisitions are in foreign countries, and how do you monitor that, and how do you? And he said, well, we just tell them what numbers they need to make, and if they don't make their numbers, we'll get somebody else in there that will. And that was just so chilling that that really stuck with me. And I think it peaked out, it rolled over, and as it was passing through the 100 to 200 range, I just, oh, well, it was dropping. We kept looking harder. And then the second thing that just iced it for us was, I think it was called Philidor, which was a distribution company that they did not buy, but they had a call option to buy the whole company for $1 or $0. And so essentially they owned it, but they were not admitting they owned it because it was about licensing in California, and it seemed to me they were violating the spirit of some regulations, and I just said, it's got to go. We sold it all. So we ended up actually making a lot on it, but not our proudest hour. Again, I think we're possibly gave it way too much leeway because it was so profitable, and that is just so dangerous.
Yeah, absolutely. And continuing on our discussion of management, in the past, you have stated in some past interviews that you believe that Henry Singleton may have been too aggressive with his cost cutting at Teledyne. Can you please further discuss your thinking on this matter?
Yeah, that's just pure speculation, but and I've seen it happen in other companies. And as I talk, I'll see if I can. Well, I can give you another example, but in the 70s. When I stumbled on him, I think it was in the mid 70s, and he would buy in stock with tender offers, with Dutch auctions, open market. He kept buying and he kept buying and he kept buying, and they kept having very good gross income results, but per share it was getting better and better because of all the buy-ins. So it was a fabulous stock. Actually, it probably was the early 70s because I remember Buffett buying options on it in 1974 during the market crash. But so I think we were gone. This is when I had individual clients at a brokerage firm, and it was a great stock. But then it turned out, and I think this is after he was gone, maybe, that the company seemed to kind of flounder. And I wondered, I think more than, I don't think I knew this, but I think I wondered if he had starved some of these technology companies for new products and new science and new ideas. And I think we saw that with ConAgra in Omaha when Mike Harper was unbelievable and had a great long run, but by the time he retired, the next guy had a real hard time with it because the people had been working really hard to make their numbers, and they'd run out of tricks. I don't mean phony or illegal, but if you hollow out, business needs to be reinvested in. And if you hollow it out, and I think that's what if I said that about Teledyne, it would be just suspecting that, just based on how the company seemed to do the next 10 years after Henry, that maybe that had happened there. That's another thing. Well, and this whole thing about making your numbers, I mean, it seems like every corporate scandal and blow up, one way or another, often comes down to pressure from the top to make the number. And whether that's with channel stuffing or just fake accounting, but it's when you get a sense, that's one of the things we are always on, our antenna are up with management, is if they do that. I'm on a board now of a public company, Cable One, and it's got a wonderful board, I think, because Don Graham, he came out of the Washington Post, and Don Graham sold the newspaper, but he still had what's now Graham Holdings, which included Cable One, and he spun it out, and he sort of handpicked the board. And it was somebody from Munger Toll's law firm, and it was Tom Gaynor, who's on the Post board, and it was me because I had a lot of cable investing experience that I'd talked to Don about. And every meeting, it's just at every opportunity, the board reminds management not to worry about what Wall Street's going to think about your earnings report. The original CFO, who's fortunately been retired, and now we have a really good CFO, but he would say, I don't know how Wall Street would take it if we didn't raise the dividend again, or if this or that. And it's like, do not make your long-term growth decisions based on what Wall Street's going to think. And so it's been really the only unfortunate thing about being on that board is I thought that I probably shouldn't own it in the mutual funds, because I might get somehow compromise somebody, and the stock's gone up 5 times and we've not owned it in the funds, so I feel bad about that, but it's been a good experience.
Yeah, absolutely. And discussing another one of your current investments, Salesforce, how do you think about investing in SaaS companies?
That's another Barton Hooper special, and he's known it for a long time. And there was a and it was always I finally did get the idea that the PE ratio was not the way to go with that one. That the SaaS model is to build up more and more and more future cash flows. And so that finally sank in. It took me 30 or 40 years, but it still seemed expensive. But they made it, I can't even remember which one it was, but they made some fairly major acquisition that Wall Street hated, and the stock went down 20 or 30%. This is several years ago. And he said, I think this is, if we ever want to own this thing, this is probably the time. And so we did put it in the value fund, and I wish we'd put it in more things. But the whole SaaS idea is it makes all the sense in the world, but it takes, there's a little act of faith that you really will get to the promised land of a critical mass of customers. But that's really not so different from, we were very heavily invested in cable back in the 80s and 90s and into the 2000s, and that always was a matter, as soon as they were just about, they'd spend billions of dollars building their plant and signing on new subscribers, and just about the time they're about to have positive cash flow, they'd have to upgrade their systems from 750 to 850 or whatever. And so it set it back a ways. And so that was a wonderful opportunity if you believed it would actually work in the end. But Wall Street didn't believe it. It gave us great chances. And at one time, I think in the late 90s, I think at one time we had 30% of the portfolio, some of the fund portfolios in cable stocks. And, I'd sell some every day just to keep it down to 30. It was a wonderful thing. Of course, one of those turned out to be Adelphia. And I don't know if you're going to ask about that one, but Adelphia turned out to be run by the Rigas family that turned out to be crooked. And I got to have my one and only day in federal court testifying against them. Yeah, it was quite an experience. And then one of my clients who ran the Buffalo Evening News at the time, so that's where Brigus was based, was Buffalo, and it all blew up. And so he said, the client said, "Well, I could have told you they're bad guys," and it's like, "Well, why didn't you?" But anyway, you asked about Salesforce and SaaS, and it's really just another, it's a whole bunch of birds in the bush, and there's probably going to turn out to be, SaaS magic is probably going to turn out to not work for some very high price stocks these days. But Salesforce is now, Salesforce has, I think they're going to have some space to rent in San Francisco. They just built that gigantic headquarters, and I don't know how it fits with work from home, but that won't sink their business.
Yeah, absolutely. And I'm very curious, how do you feel that your liberal arts background in college has helped you to become a better investor?
Oh, I am a giant believer in liberal arts conceptually. At least the way as I understand it, it's about sampling lots of different disciplines. It doesn't really matter, which combination of them, but it's about learning to learn and learning to see how things work, and to think critically. And one of my best economics courses was taught by a woman who really, what she was after was helping us spot illogical rules and that sort of thing. And so much, it seems to me, whatever anybody goes into, that being able to come into something that you know nothing about and figure out what to do, and what you need to know and what's not important to know. And in fact, that's in investing, there's usually one, maybe two absolutely key variables that are going to make or break the investment. And if you're in a narrow channel from the day you step on campus, that you learn everything there ever was about architecture or pre-med or something, it'll be great if you want to be an architect or a doctor. But my wife and I travel around, and you'll be going to some little place in Italy, and you recognize a painting that was in Art 12. Well, and that tells you how old I am, because we only had 2-digit course numbers at Carleton when I was there. I'm pretty sure they have 3 digits now, but it's like it doesn't make you another nickel, but it's fun. It makes, it's and I still buy the course. They used to be on CDs and that sort of thing, the teaching company, and I think maybe somebody bought them recently, but it's a great thing to do for half an hour on the treadmill, is to take a new course in something you have no idea about. I think I went one step too far when I tried string theory, because near as I can tell, all string theory seems to me is whenever they figure out something they can't explain, they make up another particle that must explain it, and they put that in so now it's strings. And so I couldn't quite handle that one. But history and biography and literature and art stuff, yeah, it makes you a more interesting person, I think. But I think the world needs some more liberal arts graduates, and Washington needs some, and business needs some.
Yeah, absolutely. And what's your advice for a student who aspires to start a fund in the future, especially in regards to raising capital for the fund? And also, how do you choose between, let's say, a closed-end mutual fund, an open-end mutual fund, and a hedge fund?
And I think I said this, I made a line about this in my outline. I think this, the world has changed an awful lot. And, when I first started ours, I did it as private partnerships, not to get the hedge fund fee structure, but because I didn't want to be regulated as a 40 Act mutual fund. But I did want to have a pooled thing because I didn't want to deal with separate accounts. And the world has changed. I would be interviewed by somebody, and it would be syndicated, and then all of a sudden we'd get 25 phone calls some morning from Arizona, and it turned out it was the interview was in the Phoenix paper, and they'd call, and we'd send them a prospectus, and they'd send us money, and it was all word of mouth, and it was a wonderful thing. Gradually, the third-party advisor world is in between us and the clients, and that's sort of true whatever the format, and that makes it that you kind of lose the contact with the client, which I kind of enjoyed. But it also makes it more expensive because they want 30 or 40 basis points of your fee, which used to be 100 basis points and now is 90, 80, 70 with the pressure. It's just the trend to indexing, the fee pressure, the disintermediation of the, and the need for scale. Any number of local clients of ours over the years that were very happy with their investments for their 401k or whatever, have ended up going with some giant organization because they'll provide the administration, and the administration is expensive and a headache, and their accountant can't do it. And I mean, there's a lot of barriers, but it's a fun business. And hedge fund, it's really about the fee structure. It's not about hedging. And the idea that somebody's going to pay you 2 and 20 is, I think, is pretty far-fetched. I mean, I know lots of people who've started little funds, and they've done, I mean, it doesn't take much at 2 and 20 to make a nice living and have fun. So I wouldn't be against it, but my hope is that through whatever kind of rationalization that happens when the Fed stops buying every bond that is ever printed and interest rates are not suppressed at zero, and people will find out. Here's another, I shouldn't say names, but we met with the PhD fellow who had a whole team of statisticians with a major brokerage firm. And he said with a straight face that when the 08, 09 collapse came, that they were surprised that indexing didn't provide downside protection. And the woman, our marketing person, and I were sitting there next to each other, and I mean, we both were like, oh my God, what do you say to that? But my hope is that something along the way is going to convince people that thinking about investing and distinguishing between one company and another, and margin of safety, and actually that alpha will be available again, and that somebody will notice. So I would say don't give up the ship, but a lot of the different formats are a lot easier today because technology has made it so much easier to have separate accounts, and separate accounts can, when you use a model, it's really a disaggregated mutual fund. And hedge fund is just, the 40 Act is a real pain in the neck. So if you can do it as a private fund, which I think now can have 500 or more investors. When I did it, it was 100. But in fact, I think if we start a new fund at some point, it'll probably be a non-40 Act. You have to have it's very complicated, but how the math works. You get to a certain critical mass, and it's the margins are very good.
Yeah, absolutely. So in the past, you have stated that your funds use the 12% discount rate. Could you give us some idea of how you got to that number?
Well, we use 9 now. When we first started doing DCFs, I said, well, I always thought we ought to be able to make 15% a year, and so why don't you use 15? And of course, nothing works very well at 15. And so we went to 12, and then with the market getting more and more expensive, nothing worked at 12. So now that's not a very scientific reason to lower your discount rate. But in theory, the discount rate ought to be, the risk-free rate plus 3 or 4 or something. And that, Buffett used to talk about using the 10-year treasury rate, but in all those decades, it was that meant 7 or 9 or something. And when the 10 years at 1 or 2, it just doesn't make any sense to keep chasing it down, because all of a sudden everything, there are not many stocks that aren't better than a 10-year treasury right now. And so 9 was kind of the compromise. And that's why I say, if you know how DCFs work, aside from the fact that you're guessing about what those future cash flows are, the terminal multiple makes a huge difference. And that's why I say I'm suspicious when our analyst says, this is such a good business. I think 22 terminal multiple might be okay. And what that really means is maybe it's worth 22 times earnings today. And it's just saying that it's not going to fade. The DCF idea, 5-year DCF assumes that it's, everything good is over. And maybe it isn't. And so I think, like I say, the DCF, I think of the DCF model as a conversation piece. It lays out a case that seems plausible to the analyst, and you can poke around at the assumptions about the growth rates and the margins and whether they'll buy stock back and all those things. But and I think a lot of other people use a lower discount rate, but then maybe, Mason Hawkins is a good friend of mine, and he always comes out, our appraised number is, it's always quite a bit higher than ours. For the same company, we like a lot of the same companies. So it's just what you do with it next, And so if your DCF says it's worth 100 and you buy it for 50, that's not so different from our DCF saying it's worth 70 and we buy it for 50. So anyway,
yeah.
We have a lot of debates in-house, and I'm not the guy to talk. I'm a skeptic, but I think it's a good starting point for discussion. And it's as things unfold and you realize that parts of your model weren't right and you make the corrections, I think that's a good part of the process too. So I think it's all good process stuff, but whether you use 7 or 9 or 11, it's what you do next that matters.
Yeah, absolutely. Thank you. That's very helpful. Thank you for describing that. And for a concluding question, what qualities, backgrounds, and experiences are you looking for in college students who dream of one day interning at Weitz Investment Management?
What we're looking for is people who are curious, energetic. It's helpful to have some concrete understanding of some things, but it's more about mindset and intellectual honesty. I mean, you just can't have people that kid themselves, much less kidding us. So it's a personality thing. We've tended to hire a bunch of introverts, and I think our next few hires will maybe need to be some extroverts that can liven the place up a little bit, because we do want a diversity of opinion, and somebody that's able to argue, but in a way that everybody stays friends. I think that's real important. I mean, at least for us. I mean, there's some places that you read about that are, just sound like hellholes, and they might do really good investing, but I don't want any part of that. Liberal arts guys, that's good.
Excellent. Thank you so much for joining us today. This was an incredible experience, and it was very, very helpful and very enjoyable. We really thank you. We really are grateful that you took the time out of your busy schedule.
Well, I enjoyed it. If there's follow-up questions, I'm happy to do a little email traffic if that's useful.
That's amazing. Yeah, thank you so much. Have a great day.
Thanks. So long.